Hello and welcome back, guys. So in this particular session, we will be discussing about Weston. Okay, so it is from exam kit of SPR. Okay, and what we are given in the question is we've been given SOFP, right? So Weston has appointed a new financial controller. Weston calculates cash flow from operations using indirect method. The following information relates to financial statement of Weston Group. Non-current assets (PPE) has decreased, so there might be some sell-off, some impairment. Let's figure it out. Goodwill has also decreased, might be due to disposal or something of impairment. Associate investment is this figure. If it is not given down below, this figure will be important, right? So, and then in case of PPE, we need to also look out for if there is any addition or subtraction during the year. Okay, otherwise if there has been disposal, this figure does not include the disposed of figure, right? So we need to add it up and then calculate it accordingly. Okay, because these figures include that figure, right? So it includes the PPE of the disposed entity as well. That's what I meant. So if the investment in associate is not given down below, this figure will be important. Current assets inventory has decreased. That means there might be, if there is some adjustment, we need to look out for that, especially acquisition, disposal, and then revaluation. Okay, inventory revaluation will also cause this value to change. Okay, so if there is a downward revaluation, then we might have to it's basically downward revaluation. So if that happens, then we might have to adjust this figure. Okay, and then trade and other receivables, same thing. We need to watch out for addition and disposal. And then cash and cash equivalent. So basically, if there is a disposal, we need to look out for this as well. And the cash has decreased, right? And then retirement benefit liability 7260. That means there must be a gain. That's why the value has gone down. Otherwise, it does not normally go down. So we need to prepare a reconciliation for this. Net deferred tax liability has decreased by 1. Okay. So what could be the reason? We need to find that thing out. Trade and other payables 41 to 36, right? So any adjustment for addition, disposal, and then that's pretty much it. Current tax payable will be calculated alongside this liability, right? And then the interesting thing that this question has is profit from thingy as well. Okay, so continuing operations, profit from operations 167, share of profit 16, PBT 183, income tax 40. Okay, profit from continuing operation 143, loss for the year from discontinued operation. Okay, note number 2 25. So total profit for the year 118. And then other comprehensive income after tax, okay, which will not be reclassified to profit or loss. Otherwise, normally we used to have a tax for above component, right? So this is after figure tax. Okay, so we need to find out what's the actual gain as well. And then see over here on note number 2, it's given PBT, income tax expense, and then loss on disposal is also given, right? So that was our profit, and then there was a loss on disposal. Okay, so Western purchased a 40% interest in associate for cash on 1st February 20x5. The associate paid a dividend of 10 million. So where will this basically impact is investing activities. Let's look at note number 1. Western disposed of entire 80% in equity holding in Northern for cash. The share had been acquired on 31st July 20x1. On July 20x6. Is it a mid-year disposal? 31st Jan 20x6. That means 31st July, right? Yes, it's a mid-year and disposal. The shares had been acquired on 31st July 20x1. That means it's a complete from acquisition to thingy. So after 4 years, right? X1, X2, X3, X4, right? X1, X2, X3, X4. So 4 years for a consideration of 132 million when the fair value of net assets was this much. There was a fair value uplift of 16 million in relation to plant with the remaining useful life of 8 years. Deferred tax at 25% on the fair value adjustment was also correctly provided for in the group accounts, as N is included within fair value of net assets. Okay, so that's included. The fair value of the non-controlling interest at acquisition was 28 million. Goodwill calculated on the fair value method was annually tested for impairment, right? Goodwill relating to Northern had been impaired by 75%. Goodwill is included within administrative expense for the current year, but does not relate to Northern. Okay, so impairment was there, but it does not relate to Northern. So it had already been impaired by the start of the year, right? So carrying amount of in individual accounts of Northern at disposal date are listed below the fair value adjustment, and subsequent deferred tax were not incorporated fair value adjustment. Okay, so this figure should be adjusted because of this fair value left, right? And then deferred tax as well. Where did that come from? 16, right? So deferred tax at the rate 25% on fair value adjustment was also correctly provided. Okay, so what happens is basically 16 billion. So what will happen is that excess depreciation will be charged, right? So that will basically reduce our tax liability right now, but it will increase our tax liability will be understated. Tax will be understated, right? Taxable income will be less, whereas that will be a deferred tax liability. Okay, so this figure will change, and then bank overdraft. So that will also impact our investing activities on net cash flow will be added. Let's see what we are required. So okay, this is easy. So we've been given a retirement benefit liability reconciliation is already there. See, the revaluation gain is 4 over here, and then whereas over here it is 3. Remember, 3. So that means 1 was for tax, right? Differential figure being expense for the tax. So benefits paid in the period by trustee of the scheme were 7 billion. We don't need to worry about that. Operates in a country which only allows tax relief when contributions are paid into the scheme. Okay, so when it is only contributed into the scheme. The tax base was therefore 0 at 31st Jan 20x6, and at 31st Jan 20x6 tax paid by Weston is 25%. Service component is included within administrative expenses. Okay. There were no disposal of PP during the year except on sale of Northern. Depreciation for the year was 20 million and is within cost of sales. So we are required to prepare operating activities, investing activities. Yes, flow from activities. As per our standard pro forma, before tax, and finance cost, yes, investment income, less from associate. Adjustment for non-cash item. Hold it. First thing, depreciation. Add depreciation. This will be gain on disposal of subsidiary. Will be loss on disposal of subsidiary. Subsidiary sales less assets. Okay. Add impairment. Goodwill. Add increase in provision. Changes in working capital, right? So what will be our changes? So there will be changes in inventory. Increase or decrease in inventory. Increase or decrease in trade receivables. Increase or decrease in payables. This will give us cash flow from operations. And then interest paid, tax paid, right? And then this will be our flow from operating. So let's put in the figures, okay? In this case, what has happened is that so profit before tax is 183, and there is also something we should not miss is this figure. So since it is a discontinued operation, so it will be sold separately, right? Otherwise this figure would have been added within this, so it would have been 183 plus 6, right? 189. But since it is a discontinued operation, so it is not added. That means we will need to add it up. 183 plus 6. The finance cost, I have not seen any finance cost over here. No, no investment income, only 16 from profit from associate, right? So minus 16, 0 or nothing, leave it blank. Depreciation, we do have depreciation, which is minus 20, or it is added over here. 20 gain or loss on subsidiary is not there. Loss on disposal is already there. Loss on disposal 29, right? Let's remove this, we don't need it. What we need is service component, and then contribution into scheme. So what's our service component? 11, 19. 11, right? So this was deducted, that means it will be added back. So in case of contribution into the scheme, it will be minus 19. So it's a cash outflow from the company. Impairment of goodwill. Okay, so working note. So let's create our working note. Since I think we are not given any goodwill, right? So we are given net assets, and then we need to calculate goodwill. Yep, goodwill is not given. So holding percentage 80 and 20. Structure. Parent NCI percentage 80, 20. Working note 2. Relation of net assets of Northern. Hold it at acquisition, at disposal. Okay, reporting, you might say. Post acquisition. So we need to be careful whether there has been a full thingy or not. Total assets. This figure is already given, isn't it? So fair value of net assets was 124. 124, right? And then fair value adjustment. Excess depreciation. This is 16. This is same figure from here. Additional depreciation will be this divided by its useful life into how many years have gone by. 4 years have gone by. Remaining life is 8, right? So we had counted it earlier. So it will be minus 8. Okay. So this figure will be. We need to do something else as well. So our figures are over here, right? PP, property, plant and equipment. Plant and equipment, and then inventory, trade receivable, trade payables, deferred tax liability, trade payables, liability. So you might not know this technique, but this technique is also there, okay? Overdraft. So what we are given is that our reporting dates PPE will be 80, right? Yep, 80. So this has not been adjusted for fair value. That means what do we need to do with this? That means if the PPE has not been thingy, so it should be added by 16. So it will be plus 16 minus 8. So it will be plus 8, right? But we don't need to do that. First, that figure will be added down here, right? And then inventory. What's our inventory? 38. Trade receivable 23, 38, and 23. 38, 23. Trade payables 10, right? 10. Deferred tax liability is also not, so fair value adjustment and deferred tax liability has not been included. Okay, so minus 6. Minus 6. And then another thing that we need to be careful is that deferred tax temporary difference is how much? 16 into 25%, right? 0.25. 25%, okay. 25%, okay. Deferred tax liability will be so there has been a temporary difference of this figure, right? So minus 4 into how many years has gone by? 4 divided by 8, right? Yep. So deferred tax liability will be minus 2 will also be added, okay? Minus 2. See, basically what happens is that I'll show it to you in a bit easier way, okay? So let's say 1, 2, 3, 4, right? And total. So suppose you have a profit of 10, 10, 10, 10. So when you do a 25% of this, so what happens is basically you'll be charging extra depreciation of how much every year? So 16 divided by 8 will be 2, right? Okay, so you'll be basically charging 2, right? Minus 2, you'll be charging extra depreciation. That means your PBT will be this figure. Your PBT will be 8, right? So minus 2, and then minus 2. The total will be 40 over here, minus 8 over here. So this will be 32. This will be 8, 8, right? So you will be taxing it over here, right? This is excess depreciation, PBT, tax, EAT, right? So you'll be doing this figure into 0.25, copy and then paste for everything, right? And then what you'll be doing over here is this figure minus this figure. So 6, right? 0.4, right? So we will do the same thing. So you can differential, okay? See, in this case, there won't be any excess depreciation, right? So you will only have this much figure, this much in your SOPL, right? So this will be your PBT, right? 10. So you will have a tax will be into 0.25, right? So what you will do is this minus this, copy. See, in this case, your PBT will be higher, right? So if due to this excess depreciation, your PBT has decreased, right? So how has this impacted our tax? Is that the tax would have been, due to the excess depreciation, the tax has been, see, the tax has been, it's been understated, right? So whereas the tax should have been this figure, it should have been this figure, right? So how much is the difference in this? How much is the difference? Not into thingy. It's this into 0.25, right? So the difference is 0.5 every year, right? So that means in 4 years it will be 0.5 into, it will be basically this figure minus this figure, right? Copy, paste, paste, paste. So if I add all this thing up, it will be 2, right? So that's our differential figure. So that's a deferred tax liability that's been created, right? So since we are not paying more tax over here, so that will create a deferred tax liability of 2. So that's why we need to increase this deferred tax by 2 as well, okay? So I hope you've understood it. And this is year, okay? So I'm just trying to make it simpler for you. Okay, so that's done. Our bank overdraft is minus something. It's minus 2, right? So since it is a bank overdraft, so minus 2. Sum of all this, right? So our net assets is 149, right? minus 10. Okay, so this figure will be this minus this. So let's copy paste everything. So what we are wait, were we? So we were calculating goodwill impairment, right? 3, calculation of goodwill. You know why I'm doing this? It's because in order to calculate goodwill, we need the goodwill for this subsidiary as well, because we don't know how much we've disposed. Because when making our goodwill reconciliation, we will need that, right? Acquisition. Then this will be our goodwill at acquisition less impairment. Impairment, I think there is an impairment. This will be our goodwill at disposal. So what's our investment? As per the question, it is 132 million. 132, right? 132. Okay, what's the fair value of NCI? 28. 28. Both up minus this figure. So this should give us this plus this 36. What's our impairment percentage? Impaired by 75, right? So this is only, it's already been impaired at 31st January, okay? So 36 into 0.75. So that means this figure will be basically 0.25 only, right? If you subtract 36 minus 27, you will be getting 9 anyway. Okay, so after this, quickly working note 4, calculation of NCI, right? I won't disturb the flow, that's why I'm going with it, okay? I know I have to calculate thingy, impairment for goodwill, so share of post acquisition profit, which is basically this figure into holding percentage. What's the holding percentage? 20. Okay, so that's thingy, and then less impairment, share of impairment will right, which is basically this figure into 0.4 minus 0.4. Okay, and then our sum will be NCI, right? This is our NCI. Okay, so working note 5 will be goodwill reconciliation. Okay, now I will do goodwill reconciliation. So opening goodwill, what I can do is that particulars, I'll use the classic template, copy, paste, balance, do addition, by impairment, disposal is this figure. We know that already from here. And then by closing, this figure will be basically from carry forward. Alright. Okay, so let's look at our balance sheet. So it is 19 and 4, right? So opening balance 19, and then that is 4, right? Has there been any addition? No. So the total is 19, right? So this sum of all this will be this figure, and this will be this minus 9 minus 4, 6, right? So our impairment will be 6, okay? 6 minus this figure. How much you have to do just to get one particular calculation, right? So working note 5. What else am I missing? Depreciation is done, goodwill is done. So after this, what else is there? No, provision is not there, right? So changes in working capital. So inventory will be, what's our opening figure? 165 and 108, right? 165 and 108. 108 plus this figure minus 160. So how much was the total? 146. That means it has decreased, right? 165 minus this. Okay, so what has happened is that the inventory has decreased by how much? 108 plus this figure as well, okay? Because see this 108, so this is the figure at the year end, right? So this figure is at the year end. So it's, as you can see, it's at the year end 20x6, so that's 31st Jan, right? But the disposal has already happened at 31st July, right? So this figure does not include the inventory for the disposed of subsidiary, right? Of the subsidiary. So we need to add it up so that it can be comparable with this figure. This figure already includes it. Okay, that's why we need to subtract it. Okay, that's why we need to add it to this figure. Okay, otherwise what you can do is you can do something else as well. So you can basically remove it from 165. So how much will you get? 145, right? So it has increased by how much? What was the inventory? It has decreased. Okay, 108, right? So 108. So it has decreased, right? That means inventory has decreased. So there will be positive cash inflow, right? 106. Nope. I think we will just do it the easy way, okay? It's not complicated. Not 106. It is 165 minus this figure minus 106. One weight. See, even this way, you get the same thing, okay? So either what you can do is that you can remove that inventory from this figure and then make it comparable, or you can add it up to this figure and then make it comparable, okay? Whatever you feel easy. So in case of trade receivable, 106 and 104, right? 106 and 104. That means 106 and 104. So 106 plus 104 plus this, right? So receivable has increased. So this 106 minus this. So 106 was the which figure? Okay, 104 minus that figure, right? 104 minus. So since it has eased, so what should happen is that basically it will be this figure minus 106, okay? Minus 106. Just to make it a minus, okay? Because since it has trade receivables have increased, right? That's why we are doing that, okay? So see, as you can see over here, so it is 181, right? Whereas the receivable now is 106 minus 106. See, so it has increased by minus 25. That's why I'm just doing that, okay? So in case of payables as well, what you can do is basically payables 41 minus, so 41 we don't need to do minus because it's already in minus over here. So 10, right? So that's 31. So how much is it now? How much is it now? So it's 36. So it has increased, right? So what we can do is 36 minus this. 36 minus this as well. Okay, so that will be a positive figure, right? So this will give us cash flow from operation. So it should be 178, okay? Why am I doing minus over here? All right, so tax paid, interest paid is not there, so let's calculate tax paid, okay? So working note 6, bold it, tax paid. So opening balance is basically, what's the figure? Opening balance is two figure we need to add up, okay? So current tax payable 92 and deferred tax 15. 92 plus 15. 92 plus 15, okay? And then current year. for the year, which is from our here SOPL 40, right? So that will increase our tax liability, so it's a positive figure. And then what else do we need to? I'll just leave few more gaps and then closing, right? Closing balance, last will be our tax paid. Closing balance will be 47 and 14, right? 47 plus 14, right? And then deferred tax. So what about tax from income tax expense, right? From discontinued operation. Okay, so this is continued operation. West, but this is discontinued operation, right? So it is minus 2, yeah. So that is 2. Okay. So there is also something else. So what about the tax on deferred benefit tax? There is OCI's item, and then which will basically be it's 3, and then whereas in reconciliation it is 4, right? So 4 minus 3, 4 minus 3. So which will basically be, so sum of everything 150, right? So it will basically be 61 minus sum of everything, okay? Minus 89. Let's look at something else. So what about deferred tax on disposal as well? There might be that thing as well. So remember, we did a revaluation for yes. So there is a deferred tax asset as well, which is basically deferred tax liability. Tax liability, which is a minus. Okay, that means it's a deferred tax asset. Consider it that way. Minus it. Right. So this will give us a tax paid figure of 26. Why is it giving us 26? Okay, so it should be sum of 47 as well. So it should be minus 81, right? So this is our balancing figure, okay? BF balancing figure. So working note 6. Working note 6. Minus 81, right? Or we can just link the cell. Minus 81. Okay. So that is done. Let's make this beautiful. So we can compute our cash flow from operation, sum of everything. $109, right? So cash flow from investing activities, we are required to prepare that as well. Activities, which is basically, what's our standard pro forma for that is basically we always put the sale of property, plant and equipment at first, right? Or purchase of non-current assets. Then receipts from sale of non-current assets. Okay, so net cash paid to acquire subsidiary, net cash received as proceeds from subsidiary disposal. Okay, subsidiary disposal, and then cash paid to acquire associate, right? And then dividend received, interest received, right? So for this as well, we need working note. So in case of PP as well, we need working note. This will be working note 7. Right. So working note 7. PP reconciliation, right? PP reconciliation. Okay. So opening. In this as well, what I can do is I'll just use that classic template. Copy, paste. So what has been the impairment? I guess there will be depreciation, and then disposal will be there. Closing balance, we'll figure it out. From our balance sheet, so closing balance is 389 and 413. 389, 413, right? 413. What's our depreciation? So over here 20. And then what's our disposal? How much did we dispose? It's over here 80, right? And then there is something else is there. It's about that fellow revaluation, right? Revaluation, which is 16, this fellow, and then the excess depreciation will be by excess depreciation will be this guy from here. So this will give a total of, should give a total sum of everything. It's not minus. So this will be same figure, and then this will be purchase, right? This is balancing figure. Minus this, 68, right? was our disposal? What was our disposal figure? It's 80, 20, 8, 20 minus that, right? Okay, so you can get this figure plus this figure. Okay, nothing about that, right? Okay, interesting. So what we will do is that what we need to find out is that by disposal is this plus this plus this. Okay, so 88 directly we'll just write it. Okay, we won't write this excess depreciation or anything of that sort. So same thing over here as well. Okay, so we got our purchase of 84, right? So it will be minus 84 H60, right? H60 minus H60, right? So that's there, and then no sale of NCA has not taken place, so net cash paid to acquire subsidiary is not there. Net cash from this is there, so it's 2. And then what was the cash received? Acquired for this figure. Okay, so this is again another interesting thing. So this is not there. We have to find it out. So the question has not given us how much cash we got from selling, so that will basically be a balancing figure. Okay, note 8. Calculation of proceeds, disposal proceeds. Okay, bold. So how do we calculate it? It's basically disposal proceeds and then fair value of retained interest, and then less interest disposed of, which will be goodwill at disposal from working note 3, and then net assets at disposal, which will basically be from again working note 2, and then less CI at disposal will be working note 4. Okay, put in the figures. This figure is this. This figure is minus this. Okay, so sum of this figure since we know we had a loss, right? Loss on disposal. How much was the loss? It was 29, right? 29 minus 29. So this figure will be plus this 90.8. So we did dispose of full, right? Dispose is entire 80% good. So this is 0. This figure will be same figure as this, right? So this will be our disposal proceed of 90.2. So 90.2 plus 90.8 plus. So since we have not lost cash because we have not lost control over it, so since the company does not have any cash, so it has a bank overdraft, that means that will be a gain for us. Okay, so we are just transferring them liability, right? So that's a gain for us. And then what about associate? So there was something about associate as well. 40% associate in cash. What's the investment amount? It's not given. That means we can find it in NCA 102. So minus 102 dividend received. Yes, there is some dividend received, interest in. But is that that's for everybody? So into 40% as well. Into 0.4. Who is the dividend received, right? So sum of everything. 9.2. Hang on a minute. So what did I do over here? Loss was 29, right? So how much did we basically lose? Why did I do 40? So I was thinking, why is it so high? Right? That is good. Okay, so we need to calculate. Okay, so what we need to do is that we need to create another working note for this as well. Okay, so what we'll do is that we'll just use our classic. We'll use this template. Okay, short and sweet. Working note 9, right? Working note 9. Okay. Investment in associate. was our opening balance? It's 0. Closing balance was 112, 102, not 112, 102. Okay, so there was no disposal. To share of profit will increase our investment. Is 16 or 12 or what was it? 16. Okay, so 16 will be over here, and then by dividend will reduce this figure, right? So by dividend, how much dividend did we receive? Is n into 0.4. 4 was the dividend received. That means this will be sum of everything. So that means this figure minus 16 will give us our investment to invest. To purchase H80. H80. H80, okay. No, it's pretty good. Should be minus. So that's pretty much it. So 1 and 2 cash flow from investing activities is basically in spreadsheet, is in spreadsheet. Okay, so we will move on to question number 3 after that. So 1, 2, 3. Third number question is that what we are asked by the question is, I think we need to discuss indirect method, calculate the cash generated from operations, explain how to calculate cash generated from operations using indirect method. Okay, so let's explain it. As per indirect method, as per, come on man, as per IS 7 statement of cash flow, statement of cash flow, the indirect method of calculating cash generated from operations involve adjusting profit for the period for the effect of non-cash items relating to investing and financing, investing or financing such as gain or loss on NCA, non-current assets, and changes in inventory, receivables, and payables. In case of Weston, let's explain it. The income from associate. The income from associate is not a cash flow, so it should be deducted. Isn't a cash flow, so it is deducted, and any dividend received is recorded in cash flow from investing activities. Service cost, depreciation, impairment of asset are non-cash items. So it is eliminated by adding right. So when calculating movement in working capital, is important to consider disposal and acquisition of subsidiaries, inventory, payables and receivables. When the figures are not adjusted, then is it is a distorted figure, as it does not represent cash flows with customer and suppliers. Therefore, for year on year comparison, it should be adjusted. Okay, so that is done. Customers, right? So I think a number is done. What is b number? So it's been a bit long, so I'll see you in next part. Okay, so if you've got any other questions during till over here, please do ask me. I'll definitely answer it for you. Yeah, I'll see you in next part. Okay.